The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. My name is Bobby Rains. I'm the lead analyst here at InvestorsObserver. We are here for our once every 3 weeks members only workshop. So with that, let's get started. As always, if you have any questions, go ahead and throw them in the question box. I'll either just stop to answer it in the moment or we'll get to a bunch of them later. Our agenda for today, we'll talk a little about what the market's been doing recently. I don't think we have any new Investors Observer features since the last workshop. So we don't really have a whole lot of what's going on in Investors Observer this time around. And then, yeah, the rest of the presentation is essentially member-driven content, questions, anything you want to know about the website, stuff like that. I already have a question that I put together, or at least put on a slide, and I'm ready to talk about a little bit. So that is a good reminder that in the future, if you have a question between workshops, you can send it in. Certainly you can send us a question at any time and don't have to wait for the workshop, but if it's a thing that requires a little more explanation in terms of how to handle, then that might be a good thing to talk about at the workshop. If you have the question, chances are somebody else also has had that question. So you can send those in and just mention workshop, and then we can prepare for things a little bit ahead of time. But again, if you have any questions during the session today, go ahead and throw them in the box, and we will get to them. All right. So with that, let's talk about what the market has been doing. So this is the S&P 500 over the last year. We have finally, after I feel like months of talking about it, made a solid breakout away from the 2,800 level. We're back up to this old high now. I think we broke it on an intraday basis yesterday. And it's not super rare to have a little bit of a leveling off after a run up like this here. But that's where we are. I would like to see us break out to a new high. If we can get that done, yeah, here's a closer look. This is just the last 6 months, but you can see we were within spitting distance of this 2,800 level and bumping against it as resistance and then bumping against it as support for quite some time. So I'm glad to be above that, and if we can break out and really get a little bit above this old high here, I feel like we'll be in pretty good position, for a continued rally. Double tops are a thing. They do exist, but you don't really see bear markets develop immediately after setting new highs. So this recovery from the sell-off we had, back earlier in the year has really been nice. It's good to see it get back to old highs, and if it can break out again, then I think I think we should keep running for a while. All right, let's look at the other major indices. So year to date, the Nasdaq has been the best performer, although you'll notice, it's not any great gains to write home about. We're not super far ahead of anything, but we have done okay. And then, the S&P 500 is in white there, and the Dow has lagged. So that's year to date. But if we look at the last month, the Dow is actually leading, and the Nasdaq hasn't really gone anywhere so far in the last month or so, which is a little bit interesting. It wasn't surprised to see this divergence close up a little bit. A lot of what you're seeing here also relates to some weak tech earnings in terms of things like Facebook and Twitter in particular. And then there was a big Tencent, a big Chinese one last week, I believe. And then on the Dow side, consumer staples have been strong. Generally, consumer-facing things have been strong. And then, the headlines about trade have kind of died down a little bit, which really all the trade war stuff really tends to hurt the Dow more than the Nasdaq. All right, and then in our what else is going on category, Bullets are still out of order. Yeah, earnings season is pretty much over. There's some retail guys going this week, and there's probably some other stuff next week. But we're certainly past the bulk of it in terms of there being, a couple hundred stocks reporting earnings on any given day. Things are generally good. There were some big misses. I mentioned, Facebook and Twitter. Margin compression is the thing that people are starting to say they're worried about now. You see wages starting to rise, and you see other input costs starting to rise, and you wonder how much pricing power people actually have on the other end. Obviously, if it costs you more to make the product and you have to sell it for the same price, your profit margin gets a lot smaller. So that's the thing people are talking about, but I feel like people have been talking about that for several quarters now. So, we'll see if it happens. The trade thing, it's still sort of a mystery as to the ultimate outcome. The status quo seems to be priced in as much as possible right now. Obviously, what 25% tariffs on some things actually means over longer term is still kind of up in the air. So, we could see more fallout from that in future quarters, but I expected that would show up sort of in earnings reports more than it's going to show up, in the middle of September. Somebody's just going to kind of be like, oh, this terrible thing is happening. I expect it to show up in earnings reports more than it to be some sort of crisis that develops. Again, barring some new development. And like I said, consumer sentiment is strong. Restaurant spending is up. The retailers are doing well today. TJ Maxx and Target both hit new highs today. I know we were talking here in the office about, Amazon is apparently only really killing the retailers that are bad. Somebody likes everything, so I'm sure somebody is sad to see JCPenney go, but JCPenney and Sears are not doing well, and it's related to Amazon, but Target and TJ Maxx are doing well, and they're also competing with Amazon. So that's kind of an interesting thing that's developed there. And then the Fed minutes is the last one. I didn't make it to the slide, but the Fed minutes came out today, and the short version is things are generally good, but there's a lot of uncertainty around trade, which is what I had on my slide today anyway, so that's convenient. But yeah, that's the sort of the basic gist of where things are. I expect the Fed will probably raise again in September, barring something unexpected on the trade or somewhere else. But that's really sort of what I expect to happen. And then whether or not they go again in December, I don't really know, but the chances of a raise in December were at like 93% last week, and I don't expect today's minutes are going to make those go down. That seems like it's probably going to happen. All right, so you can catch up with our musings about the economy and market on our, well, it used to be on our blog, now it is in the Market Intelligence Center. Which we brought over. We talked about this a little bit last time. But we write, in addition to the morning update and some articles that come out, every day we have a market update, usually some other article to read. We do have 2 other pieces that come out once a week about the market. Those are the weekly, the Market Week Ahead, which comes out Monday afternoons is when this gets published. And what we try to do is exactly what it says, look ahead a little bit. Right, we've got a economic events calendar and an earnings calendar. Tell you what sectors have been strong recently, and then try to put things together and tell you, sort of what we're expecting to happen for the week. And then Market Week in Review looks like this. That comes out on Friday, and we kind of try to wrap up the week in terms of give you some idea of what happened and why, look at what's going on technically with the major indices, or whatever the story that seems like it needs to be told there on Friday afternoons is. So those are great places to keep up with what is going on in the market in between listening to me once every 3 weeks. All right, so that is pretty much the agenda, and now it is on to questions. So we got a question. We only got one pre-submitted question this week, but it is a good one. It came from David. He had covered calls on Micron and Weight Watchers. The calls expired and the stocks are down significantly. Short-term out-of-the-money calls aren't paying very much. Obviously doesn't want to be assigned at a loss. The January 20 leap is out of the money and then makes a small profit over a long term, but making a small profit over 2 years is not super exciting. A year and a half, whatever that would be. And the stocks are well rated and he's hoping for a quicker recovery. So as the stock price increases, is the leap likely to increase accordingly, or there be time to buy to close? So let's go look at the Investors Observer, go to the trade idea generator, and look at some possibilities here. Do Weight Watchers first. All right, let's zoom in a little bit here. All right, so I don't know exactly where David got in on Weight Watchers, but I would guess, depending on when it was, he probably has a cost basis of somewhere around $100, or maybe somewhere plus or minus around 90, depending on if he got in up here or down here. So we can go to the out of the money covered call tool here. And let's start at $100. And so position repair, this is going to give us, yeah, there we go. That is the 2020 leap that David was mentioning. Sells for, it's up to $10 today. And so, yeah, you make a 0.6% return over, 513 days from today at a couple months. Back to whenever David opened the position, and you see that's not right at 0.6% isn't super exciting to make in a year and a half. So the income generation tool may be more useful in this case, but it does mean you're going to have to keep an eye on things. Okay, so if we look at the January 90, you get 260 for that. That will so if your cost basis is 100 and you take 260 off of there, now you're down to 97.40, which is a loss, right? So if your cost basis is 97.40 and you get assigned at 90, that's no good. But that requires a good run up in the stock. It's at 74.75 right now. And so for it to go up to 90 is a pretty big move. The delta suggests that there's about a 28% chance of that happening in the next 150 days. So that's one option. I mean, you could look at something a little bit lower and a little bit faster. What will happen is right. So if the stock stays where it is, the time value will leak out of it. And so you'll be able to get out of it a little bit faster. Now, as the stock rises, the delta will rise also. And so the time value will actually leak out slower the higher the stock gets. So, we could go through a bunch of hypotheticals here, but it would just be you listening to me talk about math. But that's the gist of it. Now, the thing is, okay, so once the stock gets to be around 90 is when you have to worry. And you could roll it out. You can roll it out and up, depending on how things go there. And yeah, so rolling is just buying back the sold call and then selling another call against it. So typically when you do that, you're going to be rolling it out in time because you can do that without having to pay money into the position. So if you were to go from the 90 to the 95, the 90 call is always going to have a higher price than the 95 call at the same expiration. So if you wanted to put cash into the position, you could do that. And now, so if the stock was at 90 and it went to 95 and you rolled it from 90 to 95, you're not really losing any money there. You're just essentially converting cash into the stock position, right? Because your net covered call position, the value goes up by $5, and the net position of your cash goes down by $5. So you're not actually losing money when you do that. You're just keeping the stock at a, from getting assigned at a higher level. And so if you roll up and out in time, sometimes you can get it for break even, sometimes you can get it for a credit. It really kind of depends on the stock and how close the strikes are and the amounts of time involved. But like, yeah, Weight Watchers has been a good stock for a long time. It does go up and down, but generally speaking, we can look here. It gets a go over a stock score report. Yeah, it seems like Wall Street likes it and has a strong buy. In terms of a mean rating, the median analyst expects it to go to 115. It's pretty beat up from a technical standpoint, but it's at some, it's got some support in this area. So it seems like it should probably be more likely to go back up than to go down further. At a certain point, it comes down to a style thing of, would you rather try to hold on to this and see what you can get out of it? Or would you rather essentially take the loss and try to put that money into something where it can be more productive? And that ultimately is a question that I can't answer. But yeah, I mean, I would look at, sort of going back and forth between certainly break even at 2020 is not super attractive. But something like the income generation tool, that's not a bad deal. Honestly, like I kind of looked at this just using my option chain and some other stuff, and that was about what I came up with today also. Now, if your cost basis is $90, this actually is, suggests a slightly different call. But if your cost basis is $90, you might still want to sell the 90. At that point, you're breaking even. But yeah, here's a shorter call that is, granted it's an 80, but it has, because it's shorter duration, right? It expires toward the end of next month instead of in January. The probability of assignment is not just nominally higher, 29% instead of 28%. But again, you're bringing some money in, you're lowering that cost basis, and then you can sell another call against it, when that expires, or if necessary, you can roll it out from there. So that's the kind of thing I would look at, and then it's really just a question of, it ends up being a thing where you have to pay a lot of attention to it. You don't want the stock to run up and get assigned. And then it gets to be kind of a balancing act of how far do you let it run up before you try to roll it. Because the longer you sit on it with it going sideways or going up very slowly, the time value will leak out, which is what you want, right? You're short the call, so the price of the call going to zero is a positive for you in this situation. But at a certain point, you do have to pull that trigger, and it can be a little bit. I'm not sure I've ever really done one of these and felt like I was making 100% the right decision. And I think if you go back and look at the track record, you'll see that we haven't always made the right decision. But selling a call somewhere around a 30 delta is not, which is what you're going to get with the income generation tool in the out of the money covered call wizard. It's not a bad deal, especially if you can get it for, $1 or $2 if you do the January one. So that's kind of how I would consider it. And then let me go back to the question to make sure I answered all the pieces. Yeah, I don't like the January 20 leap any more than David did here. And I do think Weight Watchers will look at Micron in a minute. Is well rated, and it certainly seems like the sort of thing you could hold on to. Yeah, okay. So let's go back over here and look at Micron. Boy, that is also a stock that is very up and down, although the range isn't quite as big as what we saw on Weight Watchers. But yeah, so let's look here. We could be somewhere around 55 or as high as about 60, let's say. All right, so let's say our cost basis is 60 bucks. We can look at the position repair option. And so again, this is going to be a 1% return in probably when you factor in the time David's had this position open already, probably going to end up being about a year. And that's not super attractive, especially for something like Micron that, you know, really can go up and down. And generally, I think the analysts are probably pretty high on it right now. All right, so it gets a moderate buy instead of a strong buy in terms of a mean analyst recommendation. But the you know, the actual price targets look pretty similar to what they did on Weight Watchers in terms of, you know, kind of a big increase expected there. So let's go back here and yeah, do income generation. So here we are. This one looks a lot less attractive. Just because that probability of assignment is so much higher. You know, at 49% instead of, did I submit this? Yeah, all right, it didn't rerun. There we go. All right, so income generation actually looks pretty attractive. If you do it this way, we're down to a 27% chance of assignment. Again, right, that's a September for $1.02. That's maybe not a bad deal, and you know, if you can sell $1 worth of premium for a couple of months, and you're at $10 underwater. If the stock can meet you in the middle, you get to break even in 5 months. So that's maybe the way I would handle that. But yeah, certainly for something that's down as far as these are, the position repair tool looks pretty unattractive. Okay, all right, David just said his cost is 56 on MU. So let's run this again with the real number in here. All right, so that's not terrible, let's say. But still, you'd like to have more than $1 or a 1.6% return if you're going to be in something for half a year. So yeah, with the stock at 50, and this is selling at 54.50, that gets you not super far away from break even. Yeah, so that takes your break even down to 55, we'll call it, right? Yeah, so the stock would have to come up some, but it's got to get 10% in a month. So that's maybe not impossible, but not terrible. But yeah, that's the kind of thing I would do. And then yeah, you could certainly roll that, even if you rolled this at the same level, you know, until Verizon or until Micron gets to, you know, 57, 58 or something, then that roll price starts to become pretty unattractive. But with Micron between 50 and 55, somewhere in this level is probably pretty good. And then, you know, if it comes up to, you know, if that call were to expire worthless, you can certainly come use the tool again. You could also, and this is a trick that I use a lot of times, is try to find a call with a similar, right? So if right now Micron at about 10% out of the money, a little less than 10% out of the money for a month is paying $1. You can look and see like, okay, So if it was 5% out of the money, what would that be? You can just go look at the option chain and be okay. So what is the 52.50? What's the premium on that? So you can kind of use that as a proxy for what the price would be. It won't necessarily be the case, but right, given that there's not an earnings event between now and the next expiration for Micron, it seems like there shouldn't be a giant spike in the volatility there, the implied volatility, and so you can use the option chain now as kind of a proxy for what the option chain might be in the future, right? So if a call that's right again 10% out of the money is paying $1 at right about a month away, go look and see what the one that's half of that will be at about a month away to try to get an idea of, okay, so what would this call be worth at some point in the future? All right, so David has a follow-up question here in the questions, and it's essentially would the price of the leap rise slower if you took a long position and the stock rose? So that's it's a little hard to gauge. The price of a leap with the same strike price would be less volatile, right? So a shorter dated call, your time, right? The theta, the rate at which the option loses time value is going to be higher. Okay, so this guy is going to be losing, you know, some portion of its time value. I think usually it's about 10% for a 10% of the time. So, right. So at, let's call that 30 days away, you'd be losing about 3 cents. No, 10 cents every 3 days. So you'd lose 10 cents in the first 3 days, maybe. That doesn't seem right. Anyway, the shorter dated call would 100% be losing time value faster than the longer dated call. Right now, where it gets hard to figure out as a hypothetical is, all right, so that's actually a lower strike price. Yeah, so the lower strike price, yeah, the MU, I would definitely want the shorter call with a higher strike price. And so yeah, generally, right, like two options with the same strike price and different expirations, the shorter one will lose time value. And so what that means is that as the stock is coming up and it's getting more, right, like the value of the option increases, the time value is working against you harder. Whereas, you know, if I had a 55 call that was 2 months away, it would rise in price a little bit more probably. Right, you'd be fighting a little bit harder in terms of having to buy that back as the stock went up than if it was one that was a week away. And also, right, two options at the same strike price that are out of the money, the delta will be higher on the one that is further out. So the the probability of assignment will be higher on the one that's further away because you're giving the stock more time to move. So to answer the direct question, which is would the leap be any slower to appreciate? I'm not sure the leap would be slower to appreciate if the stock rose, but if the stock just kind of went sideways, it would be significantly slower to depreciate. And so if what you're looking for from either one of these is a sort of steady increase over time as opposed to a big spike, the leap will be losing, the leap is losing time value potentially slower than the stock is gaining on you and adding to the price of the option. Whereas a shorter call, you're losing time value potentially faster than the rising stock price is adding value to the option. That felt really complicated, but I hope it made sense. And we did go over Weight Watchers a little bit. I think it looks like before you joined, so you can catch that on the recording and then follow up tomorrow if you need to. All right, so we do have another question about how do I get to the out of the money call wizard. So if you go to the stock page on the trade idea generator for any stock, the out of the money covered call wizard is right here. Let me do this real quick. Yeah, so even if you're on your phone, the button goes away, but it's still right here above the list of trades in this little menu. All right, so we have a question from Yaz about by the time we get to TIG recommendations, the price usually has moved up or down. So how do we adjust the trade? So trade idea generator is updated usually around 6 in the morning. So you should be able to put orders in at the open if you are, at the open or market, orders in ahead of the open. Options don't trade while the market is closed, so you can just put in an order and there's no worry about the stock piece being executed in the off hours. But yeah, I mean, a good way to adjust it is kind of what I was implied in what I was just saying in my previous answer is, right, if we're selling a call that's, let's say, 1 or 2 strikes out of the money. So here, right, so here for a covered call, for example, our suggestion was the stock was at 49.94 and we went with the 50 call. Well, that's basically at the money. So find the strike price at the same expiration that is pretty close to the money, and that's a good way to replicate the trade. Let's look at something that's a little bit less, be a little bit more volatile, a little bit likely to be a little bit more out of the money here. Back to all right, yeah. So we'll look at cons. So all things considered, Micron has a stock score report rating that's pretty close to the middle of the road. Right, the fundamental scores are high and the technical scores are low, so we're relatively close to the money in terms of our base recommendation for that one. Cons has a higher stock score report rating, and so we're going to be a little bit further. Well, we're not really much further out of the money here. Sometimes this comes down to where the stock prices are, or where the strike prices are. But yeah, again, we're pretty close to the at the money strike here on a covered call, but it is in all the way out to September. So since this gets updated every day, the expiration date is probably going to be about the same. You really just want to look at the relationship between the stock price and the strike price and try to replicate that, and you should be able to get a trade that has a pretty similar, a pretty similar set of sort of characteristics. Okay, any other questions? All right, one thing I did leave out of my market wrap up is the Fed is having their annual meeting in Jackson Hole, Wyoming this week, I guess this weekend. So Jay Powell is going to speak Friday morning. But the topic this week or this year is about sort of consolidation in markets and having big players and how that affects various things related to central banks. And they don't actually mean like stock markets; they really mean like economies. And so they're talking about the rise of things like Amazon and what that potentially means for monetary policy. Which somebody delivering an academic paper about potential future regulations that would have to be enacted by Congress seems unlikely to move markets. You could get a little volatility while he's talking, but I don't expect it to be a real market event. All right, so how are we doing on portfolios is the question. We're actually doing relatively well. We've had this BOTS position around for a while. BOTS is an ETF that has a lot of like robotics and automation stuff. Unfortunately for us, unfortunately for us, we managed to get in pretty close to the top. And then also it has a lot of foreign stuff. So one of its biggest holdings is iRobot, which has done pretty well. But it has a lot of foreign stuff, and the dollar has been super strong. So it has started to recover in the last few days as the dollar has slid a little bit. But it's also been pretty low volatility. So this is one where it's like 40 cents to sell a call against it, which doesn't seem worth the trouble. So we're holding on to that one. And then E-Trade got whacked yesterday by that JP Morgan announcement. They're going to go to commission-free trading. But it's actually up today. So hopefully it'll hold the line here, and this call will just expire on Friday. If it doesn't come all the way back, the call will expire and we can sell another one and probably turn that around relatively quickly. We had a little bit of a rough go there for a while. I'll go look at the closed trades. The verticals have been tough with the whippy market. But the covered calls and diagonal spreads, stuff where we can kind of hold on and let the market refine its level, that stuff has done relatively better. We had, Canada Goose didn't work out well, but pretty much everything else in the covered calls and the diagonals dating back to, we had some Skechers back in the spring that didn't do so well. But other than that, the verticals have been pretty rough. We've been tried to lay off stuff. Google, that position was fine, and then got whacked by the Twitter, Facebook earnings, even after Google's earnings were great. We tried to go short on some stuff, and then the market turned around. So the verticals have been tough with the choppiness, but we've actually done pretty well in the covered calls and the diagonal spreads, which are right. Those are the strategies where you can afford to be patient and let the market come back. Vertical spreads, you get one shot. There is no real selling another call or anything like that. So yeah, when those go bad, they just go bad. So all in all, the portfolios have done pretty well. I'm a little disappointed with how the vertical spreads have been, but I don't feel like there's a lot of methodology changes we need to make. It's just really been seems like it's been a string of headlines, or one day the market tanks, and that happens to be the day your position's expiring. There's not really much you can do about that. I'd be surprised if covered calls was in the red for the year, Kit. We did take a loss on Skechers, but it was 15%. I didn't mean to click on that. I haven't done the math here, and that took away my filter. Yeah, I haven't done the math here, but we have a 15 and a 9 and a 1, and then some big numbers in the other direction and a whole bunch of, decent gains. So it might be about break even. Like I said, I haven't done the math, but I don't think so. I guess we had that big Winnebago loss too. Yeah, so maybe for the year it is in the red. Here recently we've done pretty well. Yeah, we did have that Winnebago and then the Skechers. Skechers was a thing where we had bad data about when earnings was, and got walloped there, and Winnebago got destroyed by the trade war. They make big boxes out of metal to sell, and then somebody comes out and says metal's going to be more expensive now. You get whacked. But yeah, here recently we've done pretty well. And yeah, so we're clawing back, and if things things can stay sort of break even and not having those big losses like we did earlier in the year, I think we'll be okay. All right, more questions? All right, so we'll put up a recording of this as we always do, as well as a copy of the slides, probably tomorrow morning. And then our next workshop will be the 12th of September. You'll be able to register for that in the blog or in the post we put up tomorrow morning with the recording, and then we'll also send out reminder emails ahead of time for anyone who is interested in that. So with that, if there are no more questions, I am going to sign off here. Yeah. Hopefully we'll get that breakout above that old high in the market, and we'll be things will be back to the strong market we saw earlier this year. All right, thanks for coming, everybody. Don't forget you can get in touch with us anytime. You can hit the help button, give us a call, any of that stuff. We're always more than happy to talk. Thank you all for coming.